What is going on, traders? Welcome back to the Traveling Trader. In this video, I have another tutorial for you. We are going to go over how to grow your small account using 3 option strategies. So these are going to be 3 option strategies that are really helpful for those that particularly have a small account. And if you're sick of buying calls and puts and that feeling like a gamble, losing out on those binary bets, then this video is definitely for you, and you definitely want to stick around because you will learn something, especially if you're a beginner. We're going to be going through this on Robinhood because I think a lot of beginners trade on Robinhood, and it is a lot less complicated than something like Thinkorswim. But if you guys want me to do a tutorial like this for Thinkorswim, leave a comment down below and I will do it. And if you want access to our private trading group where we send out an options day trade watch list every morning and teach you how to trade this, then sign up. Link is in the description below. We wake up every morning neutral. This isn't part of what I'm going to show you today, but just wanted to show you there is yet another realm that you could take where you wake up neutral every morning and play either the calls or the puts, depending on how the price action breaks. This morning, as of the time of this recording, we're up 238% on Tesla, 150% on the Qs, 80% on the SPY. These are all puts, all taken on the right side of these trades here. Let's get right into it. All right, so the first strategy is going to be called a credit put spread. So a credit put spread involves buying one put and selling one put. It is a bullish position, not a bearish position, even though the word put is in it. And the reason that is because you have this quadrant here, and I'm going to go through this real fast. I go through this in the beginning of the options course, by the way. You will also find that link in the description. But say you have calls here and puts here. And here is the quadrant that you should print this out and stick it on your wall, especially if you are a beginner. You can either buy a call or a put or sell a call or a put. That's all, right? So a net buying position on calls means that you are bullish. A net buying position on puts has to have the exact opposite sentiment, means that you are bearish. And if you are a net seller of calls, you are bearish, and a net seller of puts, you are bullish. So in this case, selling a put spread is actually bullish. Now, when would we use this? And by the way, sign up for a free TradingView account. This is free. You have no excuse not to use it. But if you think Tesla is hitting a floor, right? If you think Tesla is hitting a floor, say that you think Tesla is hitting a floor at around 750, at around the 750 price level. Well, how would you play that with options if you don't know how to trade spreads? Historically, you would probably just buy a call and pray that it goes up. And if it goes down, you're going to start losing money. So when you are trading a vertical credit put spread, like I said, you are buying one put and selling one put. Now, here's a cool thing about Robinhood at the moment. Robinhood now shows you how to what your max profit and what your max loss would be. So let's just say that you expect this to happen in the short term where Tesla stays above 750. Well, know that with options, the further you go out, the more expensive they get. So if we are selling options, that means that we will get paid more. I generally like to sell credit spreads 1 to 2 weeks out. So let's just go to March 25th. Let's go to the put side. And again, feel free to rewind this, play it as slow as you want. This stuff is hard. I get it. I don't take it for granted. All right. And let's scroll all the way down to, remember that level that we were eyeing. Let's just say that we were eyeing 750. If you were eyeing a level below that or above that, that's fine. We're just using 750 as a nice round number. Also happens to coincide with Tesla's current support level around there, right? So you go down to 750, and what you do with a credit put spread, meaning when you are bullish, is you sell the higher put and you buy the lower one. So in this case, we go to the puts, we go to sell, we sell the higher put, right? So sell the put, sell the 750, and you can see here, sell 750, and we're going to be buying the 745. So buy 745. Now we created a combined order, and we are getting $1.50 or $150 for this play. Now, if Tesla stays above 750, anywhere above, even if it's a penny above, then at expiration, you retain this entire amount, 750. I mean, 150. If it falls below 745, then you lose this amount, which is 350. Now, the max value that any spread can be is $5, right? So between 750 and 745 is $5. That's the max value that any spread can be. or $500 per contract. That's what makes this really good for small accounts, because if you were to try and buy one option on Tesla, you're paying over $2,300 here, right? This is how you can keep your position size and your order size small, is by engaging in vertical credit put spreads, or vertical spreads in general. So in this case, your max collateral is only $350. This is the only thing that Robinhood will require of you, because that is your max loss. So like I said, if Tesla falls below 750, then, or 745, then you lose this amount. If Tesla stays above 750 by expiration, then you make $150. All right, you might be thinking to yourself, well, $150 to lose potentially $350, that's not worth it to me. Well, remember that we went pretty far out of the money, right? If you stayed near the money, you would get more for your option, but you would also be risking more. So if you wanted to do this with Tesla at, say, 790 and 785, you would of course get more money for this. So in this case, you're getting 220 if Tesla stays above 790, and losing 285 if Tesla stays below 785. The point is that for a small account, this is a lot more lucrative, especially on expensive options like Tesla. This is a lot more lucrative than trying to buy really expensive options that could be priced over $2,000, $3,000, $4,000. All right, the next thing we're going to talk about is a debit call spread. Remember, if we go down to our trusty quadrant here, buying a call or call spread is bullish, right? Now, here's what's cool about this, is that you can go out of the money and buy a call spread and not lose as much as you would if you bought a call and the call starts losing money because the stock price hasn't gone up, right? So in this case, let's stick to Tesla because it is expensive. If we expect Tesla to get here, which is, let's just say, above $900 soon, because that is currently still part of the trend. Again, let's not focus on the TA portion. Let's just say that your thesis is that Tesla will get to 900. Well, if you bought a call, let's go out to April 14th, which is a month from the time of this recording. If you bought a call and Tesla didn't go up, then one, the call is super expensive, but two, you are losing a shit ton of money every single day. So if you bought a call, let's say you bought the 900 call on Tesla, right? You are spending $2,400 just to buy that call, right? And I want you to take a look at one thing. This may be new to you for some of you newbies, but this is going to be losing $74 a day. This theta number right here, this is time decay. If it's minus, that means you are losing money every single day that the option does not move in your favor. So you are losing $74 a day just by holding this. Well, how do we alleviate this? Well, we could do what's called a vertical debit call spread, which is a bullish position. Now, for a vertical debit call spread, you are going to be buying the lower call and selling the higher one. So in this case, we buy the 895 and we're going to sell the 900. Now we have a vertical call spread. And if Tesla is above 900, because remember, if based on our rudimentary technical analysis here, we're expecting Tesla to hit 900. If Tesla is above 900, we make $365. If it's below 895, then we lose $130 or $135. This price keeps jumping around. So that is a much cheaper way, especially for a small account, of having a bullish bet on Tesla that it's going to reach a certain amount. Now, remember, with the vertical credit put spread, we set a floor. We were saying that Tesla is going to be above this level, and we weren't getting as much for it because Tesla is already above that level. So you were just setting a floor. In this case, with the vertical debit call spread, we are setting a price target that's out of the money. So if Tesla gets there, then we stand to make a lot of profit. You could essentially 3x your collateral here for buying this debit call spread, right? Because it's only costing you $1.35 or $135 per contract, as opposed to $2,400 to buy the 900 call and losing $74 a day just by holding it, right? In this case, you could buy this for $135. If Tesla's even a penny over 900 by expiration date, in this case, we have over a month left till expiration, then you get to bank almost 3x at $370. Not quite 3x, but under 3x. All right, so the next strategy we're going to learn about is called an iron condor. An iron condor basically means that you create a range, and if the stock falls anywhere in that range, you get to keep 100% of the profits. If the stock falls outside of that range, then you lose what basically your max loss, and you'll see it here on the graph, but your max loss is defined by the width of the spread on either side minus what you collected for selling that iron condor. But I'll show you here, so hopefully it doesn't confuse you. So in this case, let's assume that AMC is going to stay between $14 and $19, this range that it's been trading in for over a month, actually. Okay, let's just arbitrarily say that. So between $14 and $19. So follow me here. What you're going to do is you're going to set up the call side first. So in the iron condor, the upper range, the higher price point, is going to be dictated by calls, and the lower price point is going to be dictated by puts. So if we are setting this between $14 and $19 for AMC, what you would do here is you would sell the lower call. So in this case, let's sell the 19. You'd buy the 20. So you're creating that upper range here, right? And then we're going to go to the 14 area and go to the put side. Same expiration. Go down to 14. What you're going to be doing is you're going to be selling the higher put. Change this to sell 14, buy 13. Okay? Check this out now. You have a range here. So all AMC has to do for you to collect 100% of this $57 is it needs to expire between $14 and $19, right? And the max value of this spread is going to be $100. The reason is because there's a $1 difference between the calls and a $1 difference between the puts, right? And you might think to yourself, oh, well, why isn't the collateral then or the max value $200? Well, because only one side can be a maximum losing side. Either you're going to lose on the calls or you're going to lose on the puts, because AMC is either going to be, if you lose, above this or below this, and it can't, you can't lose on both sides. So the max value of the iron condor is going to be $100, and your max loss is going to be 100 minus what you collected for the selling the iron condor. That's why your max loss here is 42. Your max profit is 58. So in this case, if AMC is anywhere between $14 and $18, you get to keep 100% of what you sold this for. And your max loss is only going to be 42. And the collateral required for this is only going to be $100. Great for a small account. And you can extrapolate this and take it to even more expensive options like Amazon or Tesla or Google, or you can keep it isolated to or reserved for cheaper options, and you can create these setups that don't require a ton of collateral and gain some great experience and exposure to options trading. You learn a lot by conducting these trades. So there you have it. 3 strategies, really quick, for a small account that will help you grow a small account. You can 2x, 3x sometimes, and we will go over different strategies in the future. You can even set up extremely lucrative trades where you're trading something like an out of the money butterfly, where you can even 40x or 50x your position. Obviously, the chance of profit is much lower with odds like that, but you can set that up. Anyway, traders, that is it for this video. Remember, there's an options course below where I go over all of this stuff. There's even a Robinhood module teaching you how to roll your options, teaching you how to mitigate them, iron condors, butterflies, vertical spreads, you name it. It's all in there. Diagonals, calendars. If you want access to our private trading group where we send out the options day trade watch list every day, we go over hedges, how to hedge your portfolio, how to buy puts or short call spreads when the markets look toppy and look like they're about to tank. We talk trades all day, every day, thousands of traders. It's a great group. Link is in the description below. Subscribe to the channel. Let me know that you like videos like this. Leave it in the comment section below. Hit that notification bell. Stay safe out there, traders. Peace.